One of the biggest advantages of a scientific education is how it teaches you how to think in a structured way. One thing that they drilled into us into Caltech, it sounds a bit cliche, was thinking outside the box. And throughout my career, we actually ended up creating quite a few innovations that I think changed large parts of the investment industry. And that's because of that thinking outside the box idea. When I was hired at Salomon Brothers, as you can imagine, I was hired in the research department, which was probably at the time the top research department on Wall Street. Now, even though I didn't know much about Wall Street before going there, it didn't take me long to realize that I'd much rather be on the trading side than the research side. Now, at that point, I did something which was completely unthinkable for people on Wall Street. The Salomon Brothers training program was the most coveted training program at the time. Once I decided that I want to be in trading, not in research, I tried to bring that up with my boss at Salomon, but I couldn't do that at Salomon before completing my 2-year program and so on, and I was too impatient. I've always been too impatient in my life. So I actually decided to leave Salomon after 6 months and joining an ex-Salomon trader who had been extremely successful at Salomon. He was sort of the grandfather of currency options. Had left Salomon to go to Bankers Trust, where he made a few $100 million breaking the New Zealand currency. Then ended up leaving Bankers Trust to become head trader for Soros. And by 1993, he was managing a $500 million hedge fund, which in today's dollars is like a $10 billion hedge fund. So I remember sitting at my cubicle at Salomon, and this friend of mine comes over to my cubicle and throws a copy of the Wall Street Journal on my desk. And back then, the Wall Street Journal had the classified section, and there was a job that he had circled, and it said, "Rocket scientists wanted." So he throws the journal on my desk, and he says, "I just interviewed with these people, and they dinged me, but I think they're looking for somebody exactly like you." So I called them up, and that was the hedge fund. It was actually in Inglewood Cliffs in New Jersey. I went there for an interview, and they hired me right away as a trader, trading currency options, and also developing quantitative trading models. So I left Salomon in the beginning of 93, or mid-93, to join this hedge fund. And that was essentially where I built my first quantitative trading portfolio, which was a fairly simple long-term trend following strategy portfolio. So there are several ways of trading. Broadly speaking, you can classify them as discretionary trading or quantitative trading. Discretionary trading is when you analyze whatever factors you want to analyze on the market, which lead you to a trading decision. A quantitative trading is when you let computers make those decisions. Now, the world at large makes a very sort of distinct separation between discretionary trading and quantitative trading. I don't think of it this way. I think of it more as a continuum, in the sense that, like, throughout my 30-year career, I've met the top traders or the top investors in the world. And one thing in common to all these top investors is that it's not like they wake up one day and they dream about Apple stock or something else and they go and buy it. Every great trader or investor has a thought process. So if A happens, then B happens, then C happens, then I will buy this stock, let's say. And if I buy the stock, my target on the stock is this price. But if it starts going against me, then at some point, if it goes to a certain level, I realize that I was wrong on this trade and I will exit this position. Now, for somebody like me who grew up in a very sort of scientific, quantitative way, that looks like an algorithm. So if I'm able to identify if B happens, then C happens, if B and C and D happen, then I will do X. And if I do X, then I will exit at a profit here or stop the loss Y. To me, that's something that I can put it into an algorithm. And if I can put it into an algorithm, I can program it. And if I can program it, I can go back and back test it and see how it did over time. and see if I can run it on multiple markets, see if I can run it on multiple time zones. And a computer at that point will be much more efficient in executing these trades than me. Because one of the biggest pitfalls of discretionary trading is emotions getting in the way. Quantitative trading takes the emotion out of it. So for me, I don't see such a huge separation between quantitative trading and discretionary trading. I think it's basically one continuum where if you have a rational investment process, you should be able to put it into an algorithm. If you put it into an algorithm, you'll be able to program it very easily. If you program it, then you can backtest it and do all these things with it and run it, without any emotion on a computer. I started off trading currency options at this hedge fund. By 1994, the two partners in the hedge fund were fighting with each other, and it looked like the firm was going under. The trading partner, who was my boss, was interviewing with major banks to go work there and leave the fund. One of the banks he interviewed with, UBS, unfortunately didn't offer him a job, but they came back to me and said, you would like to have. At age 25, I was recruited by UBS, which is one of the top biggest banks in the world, to essentially start and run their global groups in exotic derivatives. I mean, if you think derivatives were these, high-risk, complicated things, exotic derivatives were derivatives on crack. To this day, I can't believe that they put that responsibility in the hand of a 25-year-old. But somehow it worked. So I built that group in New York from scratch, sales, trading, research, everything. Then moved to London, did the same. Then moved to Tokyo, did the same. I globalized that business, turned it into one of the most profitable units within UBS. And actually, I had my most fun day trading while running that group at UBS, where during the Asian crisis, so it started in 1997, we had a situation where if I could break the peg on dollar Hong Kong, dollar Hong Kong is pegged to the US dollar, and the Chinese central bank protects that peg. So we had a situation where if I could break the peg on dollar Hong Kong, I could realize about $200 million gain for the bank in one day alone. So I actually devised a strategy to break the peg, and it worked. So if you actually look at a chart of dollar Hong Kong, that peg has never been broken except for one day during the Asian crisis. That was yours truly. If you look at that chart, it looks like a bad data point, but actually it actually happened. The peg broke. I remember that night, I was living in Tokyo at the time. I took out the whole trading floor to the most expensive Kobe beef restaurant in Tokyo, and the bill was astronomical. But I didn't want to expense it. I wanted to keep it as a souvenir. So I paid for it myself. I still have that bill as a souvenir from that day we broke the peg on dollar Hong Kong. For anybody who's traded foreign exchange, Forex markets are open 24 hours a day and extremely liquid. And they start at 4 p.m. Sunday night in New York, and they close at 6 p.m. Friday night in New York. They're extremely liquid and trade throughout the whole period, except for Tokyo launch. When you're not living in Japan, you hear about Tokyo launch, essentially liquidity dries up dramatically over Tokyo launch. But I didn't realize what Tokyo launch meant until I was living in Japan and went through it. Essentially, at the noon hour in Tokyo, half the traders put their head down and go to sleep on their desk, and the other half goes out for lunch. So the strategy we came up with was essentially to wait for Tokyo launch, wait about 15 minutes inside Tokyo launch, so to make sure whoever is going to a restaurant is gone, whoever put their head down to go to sleep has fallen asleep. And then we gathered essentially every desk, UBS desk around the world. And the idea was to jam the currency. So essentially, if we start selling from all around the world the same thing at the same time, we should be able to jam it past the peg level while no one is watching. And all we needed to do was to get one print below the peg level. And then and then we're fine. We can buy all our shorts back. Now, what we hadn't taken into account during that crisis was there were a lot of stops in dollar Hong Kong all the way down to the peg and below the peg. So initially we thought, we'll sell a few $100 million to do this, maybe $1 billion or so. But as we started selling, we started triggering the stops that are already dormant in the market, and then that created the momentum on its own. So it took us a fraction of what we thought we were going to sell because of all these resting orders in the market. And then as we broke the peg and it started accelerating lower, we were essentially the bid below buying back everything we sold higher. So we actually ended up making money on the trade aside from the money we made on breaking the peg. So it worked out fairly well. I think one of the biggest advantages of a scientific education is how it teaches you how to think in an orderly way, in a structured way. And that has always been with me in everything that I did. And one thing that they drilled into us into Caltech, it sounds a bit cliche, was thinking outside the box. And throughout my career, we actually ended up creating quite a few innovations that we're credited with that I think changed large parts of the investment industry. And that's because of that thinking outside the box idea.